You are sitting at the kitchen table on a Sunday evening. The house is completely quiet. You only hear the low hum of the refrigerator. On your laptop screen, a spreadsheet is open. You have spent the last 2 hours typing in every account balance. You added every estimated interest rate. You put in the projected monthly expenses you think you will have when you finally stop working. You stare at the final number at the bottom of the column. It is a real number, but it is not enough. You know it. Your chest feels heavy. Your throat is tight. You do not recalculate. You do not look for a mistake. You just close the laptop slowly. You slide it away. You sit there in the dark, and you say absolutely nothing to anyone. The financial industry looks at that quiet panic and offers a checklist. They treat retirement like a math problem. They think it can be solved by standard rules and generic charts. But when you are standing in your 50s, looking down the barrel of the next 20 or 30 years, retirement is not a math problem. It is an accumulation of choices, habits, and transitions. These things feel completely different from the inside than they look on a piece of paper. There is an entire architecture to this final stretch of your working life. It is a series of distinct stages. Nobody prepares you for them. The spreadsheets cannot measure the weight of these decisions. Level 1, the avoidance stage. You are between 50 and 55 years old. You have entered the zone where you simply do not look. The Federal Reserve tracks this exact behavior in its annual report on economic well-being. They note that 27% of non-retired adults in this country have absolutely zero retirement savings. That is a massive statistic. But the statistic does not describe the texture of a Tuesday night. It doesn't show what happens when the topic of the future comes up at dinner. You change the subject. You talk about the kids. You talk about the leaky roof. You talk about the absolute mess at work. Avoidance in middle age is a specialized skill. You do not forget your 401k login credentials because you are disorganized. You forget them on purpose. Every quarterly statement arrives in your inbox, and you archive it without opening it. Reading the numbers means acknowledging the gap. It is the gap between the life you are living and the life you can afford later. You tell yourself you will get to it next month, or you will look after the next car loan is paid off, or you will check when things settle down. The weeks turn into quarters. The quarters turn into years. The silence around your own money grows heavier every single day. Level 2, the first honest look. Then, something breaks the silence. You are somewhere between 52 and 57. A single event forces you to look. Maybe your older sibling calls to tell you they just signed their retirement papers. You realize with a jolt that you are next in line. Maybe you have a routine doctor's visit. The physician looks at your blood pressure numbers, drops his pen, and asks how much stress you are under at the office. Or maybe you get a sudden, cold email from corporate. They announce a restructuring, and you realize your salary is just a line item. It is a line item they are actively trying to eliminate. You open every account simultaneously for the first time in a decade. You log into the old provider from 3 jobs ago. You look at the current balance. Vanguard's latest research shows the real middle of the room. For Americans aged 55 to 64, the median retirement account balance is $95,642. Every financial planner loves to throw around the standard 4% rule. This rule says you can safely withdraw 4% of your savings each year without running out of money. Here is the reality of that calculation. When you apply that rule, a median balance of $95,000 translates to exactly $3,825 a year. That breaks down to exactly $318 a month. Stop and picture that actual number. $318. That is not an abstract concept on a chart. That is a single trip to the grocery store and half a tank of gas. It does not cover the electric bill. It does not cover the insurance premium. The illusion that everything will just work out dissolves completely. You are left staring at the raw, unvarnished truth of what your current trajectory actually buys you. Level 3. The correction begins. This is where the shift happens. You are 53, 55, maybe 59. You make a quiet, stubborn decision. You are not going to drift into poverty. You do not make a grand announcement to your friends. You do not post about it. You just start clawing your way back into the game. You learn that the IRS allows you to make catch-up contributions once you hit age 50. These are extra investments the government lets older workers make to build up their accounts faster. In 2026, the standard 401k contribution limit for workers under 50 is $24,500. But because you are over 50, you are allowed to shovel an additional $8,000 into that account. That brings your total annual limit to $32,500. Here is another thing. If you are between the ages of 60 and 63, the rules change even further. The government allows a super catch-up contribution of $11,250 instead of the standard $8,000. Look, forget the complex tax codes for a second. What those numbers actually mean is simple. The system finally gives you a legal edge, and you are going to take it. The emotion in this stage is a strange, potent combination. It is a mix of deep urgency and sudden calm. The anxiety kept you from opening the statements for 5 years, but now it begins to lift. It is replaced by the cold satisfaction of taking control. You look at your paycheck and you pull the leverage available to you. You stop buying things you do not need. You are not denying yourself. You are doing it because every extra $1,000 feels important. Squeezing that money into that account feels like buying another yard of runway for your life. If nobody showed you this window existed, that is what this channel is for. Level 4. The acceleration window. You enter the most critical decade of your financial life between the ages of 55 and 62. This is the acceleration window. It opens with a distinct shift in your household. The children are finally launched. Or they are close enough to the exit that the grocery bill drops by half. The mortgage has hung around your neck for 25 years, and it is suddenly down to its final 5 or 6 digits. Your income is likely at its absolute peak because you have decades of experience. For the first time in your entire adult existence, the cash flow isn't being sucked away by pediatricians, sports equipment, and braces. Data from major retirement providers like T. Rowe Price shows the massive impact of this period. If you maximize your retirement contributions during this exact 10-year window before you stop working, you can increase your final nest egg balance by up to 40%. That is compared to simply maintaining a flat, unadjusted contribution rate. That 40% is everything. It is the difference between surviving on a fixed income and actually breathing easy. But this window closes faster than anyone expects. The temptation to spend that new surplus cash is incredibly intense. You want to buy an upgraded vehicle, a bigger boat, or luxury vacations. You feel like you have earned it after 30 years of grinding. But this window requires you to face reality. You must recognize that these specific years are your final opportunity to compound money at scale. This is your last chance before you lose the ability to earn a wage. Level 5. The identity question. You reach 58 or 64, and the numbers on the screen are finally starting to look like enough. They are not perfect, but they are solid. The panic is gone. And that is exactly when the second, deeper crisis hits you. Do not mistake this for a simple emotional phase. This is a massive financial risk. If you do not prepare for who you actually are when you stop working, you will destroy your financial plan out of sheer boredom or panic. For nearly 40 years, your alarm has gone off at the same time. You have worn the same type of clothes. You have driven the same route. You have answered to a title. Your identity is completely intertwined with being a provider, a manager, a technician, or an expert. The thought of stopping doesn't feel like freedom. It feels like an erasure. You look at your retirement date, and you feel a profound sense of hesitation. This feeling has absolutely nothing to do with money, but it dictates how you spend it. You realize that a spreadsheet can calculate your withdrawal rate, but it cannot calculate your life. It cannot tell you what you are going to do at 10 o'clock on a rainy Tuesday morning. Nobody will be expecting you anywhere. Nobody will be calling your phone. Your email inbox will be completely empty. People who ignore this risk end up returning to bad jobs out of desperation, or spending money trying to buy a sense of purpose. You have to mourn the end of your career before you can actually step into the next phase. Dismissing that weight is the quickest way to end up miserable. Level 6. The decision point. The choices become completely permanent between 60 and 67. You are no longer projecting. You are executing. You have to decide exactly when to file for Social Security. You have to navigate the transition to Medicare at 65. You have to choose a drawdown strategy, which is the exact plan for taking money out of your different accounts. You must choose carefully to avoid getting absolutely slaughtered by the Internal Revenue Service. Research from the Center for Retirement Research at Boston College and the Bipartisan Policy Center shows a harsh truth. Only 4% of retirees make the financially optimal decision about when to claim their Social Security benefits. The vast majority of people claim too early, and they leave an immense amount of wealth on the table. For someone whose full retirement age is 67, filing early at 62 means a permanent 30% reduction in their monthly check. That reduction lasts for the rest of their life. Conversely, waiting until age 70 increases that benefit by 8% every single year past full retirement age. That results in a guaranteed monthly payment. It is a payment 43% larger than if they had claimed at 62. The weight of this level is the absolute finality of it. When you sign those papers, you lock in an income stream. It will dictate your standard of living until the day you die. You are making a high-stakes bet on your own mortality. You are betting on your spouse's health and the future performance of your remaining investments. The numbers stop being theoretical configurations on a computer screen. They become the exact boundaries of your daily existence. Level 7. The other side. You land on the other side between 65 and 72. There are two distinct versions of this stage. Both of them are completely real. In the first version, you are 68 years old. You are sitting on a porch with a cup of coffee. Your Social Security benefit was optimized because you used the acceleration window to bridge the gap. That means your guaranteed monthly floor covers your baseline expenses. You look at your investment portfolio without fear. It is a resource that can remain invested. You do not need to liquidate shares every time the market has a bad week. You have identity, you have security, and most importantly, you have time. In the second version, you are 68 years old, and you are sitting on the exact same porch. But you are looking at an Excel sheet again. You did not utilize the catch-up contributions because you bought the luxury SUV at 56. You claimed your benefit at 62 out of a sense of fatigue. Now, the inflation of the last 6 years has eaten right through the purchasing power of that permanently reduced check. Every single month is a calculation of sacrifice. You are checking the price of eggs. You are calculating the cost of your prescription refills. You are realizing that you have to go back to work at a local retail store just to keep from dipping further into a dwindling savings account. The 54-year-old is sitting at the kitchen table. The house is still quiet. The hum of the refrigerator hasn't changed. But it is a different Sunday evening. The laptop is open. The spreadsheet is there on the screen. It shows the exact same deficit that caused the panic 6 months ago. This time, the hand doesn't reach out to close the lid. This time, the screen stays bright. The pencil stays in the hand. The fingers move back to the keyboard. They begin to type in the numbers for the catch-up contributions. They adjust the retirement age from 62 to 66. They watch the column recalculate. They look at the new number until the weight in the room finally begins to shift.